In terms of what we should be watching, you look at the economic and the fundamentals, and the U.S. economy right now is showing a lot of resilience, showing good growth from the consumption part of the economy.
So as we talk about the idea that the economy is front and center, are there places that we should be a little bit more worried about or focusing in on as a possible indicator for the broader outlook to come?
In the short term, we see the risk as being from the global economic activity. So certain areas within the global economy are slowing. In particular, the trade-oriented economies of China, Germany, and Japan are seeing slowing activity. So that to us is the biggest short-term risk. On an intermediate level, part of this is we expect the Federal Reserve to be on hold from an interest rate perspective. That only works if inflation is still contained. And so from an intermediate risk level, we look at, is there any signs of inflation, which today there are none.
Is there a sign, though, is there a worry? I mean, this is an outlook. So is there a worry among you and perhaps your clients that inflation could pick up and start to perhaps change Fed policy going forward?
We would say not at this point. And so embedded inflation expectations have come down here over the last few months. Part of it is the global economy is slowing, and so there's a lot of excess capacity globally, and that is feeding over to lower inflation expectations. For us, it's just something to look at over the intermediate term in terms of that's the risk that could change Fed policy, mean higher interest rates, both on the short end as well as the long end of the curve.
Some of the economic data we've been focusing so much on has been geared around the consumer and consumer spending, the health of the consumer economy. Any indication from your studies or research about what the health of the consumer is and how that carries forward into the rest of the year?
Yeah, we are positive on the consumer. So even with a slightly lower private employment report this month, we think the labor market is strong. So you are seeing wage hikes in the 3.5% range. Job openings are at all-time highs. So there's a lot of positives coming out from the labor market, which is flowing into high or rising personal income. We believe that as income rises for the average person, some of it they may save, they may pay down debt, but invariably it ends up in terms of higher levels of consumption. And so that's, to us, why the U.S. economy, relative to the rest of the world, is showing a lot of resilience, is just the health of the consumption, the labor market, the income levels that we see here in the U.S.
It sounds like your wealth outlook is generally constructive and positive, but there are risks out there that you have to be worried about. So we just have a few moments here. What exactly would be the risk that you are most keenly aware of right now?
Yeah, we would say it's the slowdown in the global economy. We saw the Federal Express news, in terms of their earnings shortfall or concerns about the global economy. To us, in terms of what it means for the U.S., it's not that it will cause a recession. We've seen that over the last 10 years, that Europe slows or the rest of the world slows, but it doesn't necessarily mean a recession. But it does have an impact on our economic growth, and more importantly, it has an impact on company earnings. And where we see the valuations of the market after the rebound from the December sell-off is valuations are fairly close to average or a little bit above average, and you need to see that earnings growth come through. So then to us, it's the potential for an earnings risk.